Hey, everybody, welcome to today's show. So, I think one of the biggest misconceptions that we as business owners may have is believing that if a bank says no, our business isn't fundable. But the reality is that many strong businesses are declined simply because they don't fit a traditional lending model. So, today we're going to talk about why that happens, how lenders are evaluating our businesses beyond a traditional credit box, and what entrepreneurs need to understand about using the right type of capital at the right time, especially in industries where growth requires significant investment in equipment, inventory, and operations. So, our guest today, Eric Olsen, CEO of SFS Lenders, has spent more than 2 decades helping businesses access capital across construction, trucking, excavation, and other equipment heavy industries by looking beyond the standard lending model and finding solutions where others may see challenges. Eric, welcome to the show.
Thank you very much. Appreciate it.
So happy to have you here today. I think this is a lot of what we're going to cover today is on the mind of just about every business owner. And I'd love to kick us off by what I call the, why was I declined question? Because I think when we're declined for something, that's the first thing that goes, through our mind. So if you're looking at a business that has revenue and customers, why would that business necessarily get declined? So what are we as business owners misunderstanding about how you as a lender would evaluate us and the risk?
Yeah, that's a great question. And I think that one of the biggest answers to that question is that most of the traditional lenders, banks and the big institutional lenders, are using other people's money to fund their loans. And so a bank is using all the depositors' money. So they're regulated by the federal government, and they have certain policies that the customer, the borrower, has to fall into. So they have to be able to check every single one of those boxes in order to protect the investment of the depositors for their money going out as a loan to this new borrower, right? So banks are very policy driven. And if you don't have the right credit score, the right time in business, the right collateral, the right age of collateral, it's an automatic decline. Or if you've had a bankruptcy in the past, that can be an automatic decline. If you have any kind of a credit story to tell, that can be a decline, because if it doesn't fit their policy, they're just going to decline you. So there are lots of viable businesses out there that are doing really well, but they might have a little bit of a story to tell, or they might be in a cash timing difference now that they weren't in 6 months ago, and they're still very financeable, even if the bank can't help them at this particular time. And that's where my company comes into play, because we call ourselves a common sense lender. We're going to listen to the story, and if there is, if they've had a bankruptcy in the past, or maybe if one of the guarantors has lost a home in the past, or gone through a divorce, or had something that has created some kind of a negative story to their credit situation, we're going to listen to those details, listen to that story, because it's our money, so we get to make our own rules. We do have a loan policy, but we can step outside of that policy if something makes common sense, in order to get the loan done to help the business grow and to help us get the loan as well.
Can you give me an example from a loan that you've done in this past year where there was such an instance of this particular business owner had a story they would not fit the traditional lending model, and maybe some specifics on what you saw in the story that allowed you to feel comfortable to say yes?
Sure. Yeah. In fact, two particular loans come to mind. One was an excavation contractor here in Utah, and they were very bankable. They had done loans at the bank before, but the owner was looking at buying a 2006 dump truck. He was very familiar with the truck. He'd had his mechanic check it out, but the bank just said, nope, that's way too old. We're not going to finance that for you. So it was referred to me by the banker, and we had no problem in doing that loan for him. We did it over 48 months. And even though his credit was very good and he was very bankable, the bank would not finance that asset for him. And we had no problem doing that. So that was a perfect fit for us in being able to help his business get that dump truck where the bank couldn't. Had another customer that had a loan at an existing bank, and their pay history had been really, really good. And the bank actually contacted them. They were a manufacturer. The bank contacted them and said, are you looking at getting anything else? And he said, yep, I've got a lathe that I need to purchase. And they said, great, we'd love to help you with that. So he sent the purchase order to purchase the lathe. The bank ran his credit, and they came back to him and they said, oh, sorry, we can't help you. Your credit score is a 645, and our credit minimum is a 650. So he missed it by 5 credit points, and they would not budge. They would not step outside of policy. He asked the upper management to reconsider because he was an existing customer with a great pay history. But again, because he was outside of policy, they declined him. Now, some banks might have had a little bit of flexibility in lending again to an existing customer like that. His bank at that particular time would not. And so it was referred to me, and we were able to do that loan and got that thing done for him within 2 days. So those are a couple of examples of things that business owners may not understand, may not understand that their situation isn't a current fit for the bank. Maybe right now it's not, maybe 6 months from now it will be. But there are alternative sources out there. And it's like my tagline is, when the bank says no, call Eric O, because I'd like to be able to help these businesses that get declined by institutional lenders or bank lenders in getting the loans they need for their businesses.
It feels to me like that inflexibility means the bank is really leaving a lot of business on the table. And they're not necessarily, and I'd love to get your opinion on this, they're not necessarily thinking about the relationship as a whole or how this is going to affect who they're saying no to. I mean, if it was me and we're talking about 5 credit points, I might consider banking elsewhere.
Yeah. Yeah. And I work with a lot of bankers because a great referral source for me are banks that do equipment financing that get declines. And I try to help them add value to their customers and their relationships by not saying no to them, but by saying, we can't help you, but I know someone who can. But one of the things that I hear from these bank equipment finance people a lot of times is their frustration in originating a transaction, spending a lot of time calling dealers, calling customers, originating the transaction, taking it through credit underwriting, and having it be declined for, something that doesn't seem reasonable. And there is a lot of frustration on that front. And so I think they do miss out on a lot of business. However, they have to be very careful, because if they do a loan outside of policy and they get audited, then the government can make them reserve funds to cover those loans that, even though they haven't defaulted, they're outside of policy. And that constricts their ability, their lending ability, because it constricts cash that they're able to lend out to other people. So it's really designed to protect the depositors. And sometimes it's a little bit too conservative, that it costs them business.
5 credit points. That is just absolutely astounding. It's not like we're saying it's 50 points, or it's 100 points. We're talking about 5 credit points. I mean, that's, to me, that's just such a short distance between where you are and where you need to be. So that's so great to know, though, that they just simply don't have necessarily the same type of flexibility that you have and that you can provide to your clients. So for the businesses that you're working with in construction and trucking and excavation, like these very equipment heavy industries, do you think that growth, creates any type of a unique challenge? And what do they, and why do you think, if so, that it also requires such a different approach to financing? Now, you gave us one example earlier, which is the age of the equipment, but is there anything else in there that you can think of that really says, hey, if you're having this instance, you're going to need a different approach?
Yeah, absolutely. And I think for a business owner, I think one of their most difficult responsibilities is cash management. Cash is the oxygen of a business. And if they are sitting on a large sum of cash, once cash is spent, it's very difficult to replenish. And so if they have equipment purchases and they pay cash for those pieces of equipment, and then their working capital is thin, or they don't get paid on a job in a timely manner, now they're in a timing difference, and they've completed the work, but they haven't collected the money, and they have payroll due, or they have to buy materials or supplies, or they have other working capital needs, insurance premiums or whatever to run the business. Managing that cash can be very, very difficult. And that's one of the things I love so much about our loans, is that we do simple interest loans, not as a bank, but what that does is it gives them flexibility to either keep the monthly payment in place, or they can pay it off early. And if they do have a surplus in cash, or if something, if they come into a bunch of money and they want to retire the debt, that's easy to do, but they always have that flexibility. Where if they get into a lease or an equipment finance agreement, they're a little more locked into that, and paying those off early can be a lot more difficult and can cost them a lot more money. Where a simple interest loan, it's really easy to pay that off virtually at any time. So they always have that flexibility of keeping the monthly payment or paying it off, but that helps them to manage the cash in the business. And I always tell business owners, too much debt obviously is a bad thing, but not enough can be a real mistake as well.
And you just touched on exactly where I was going to go next, which is growth creating cash pressure. So within the business. So are you seeing a lot of business owners coming in that have actually started to build legitimate business credit that could help with this, help keep the revenue in the business and allow them to use leverage this way other than just loans?
Yeah, yeah. So I think that there are some really organized, really good business owners that I've seen, and a lot of the ones that I think have been the most successful that I've worked with are ones who use a fractional CFO, who they have an outside accountant or an outside voice to help them manage that cash, to help them to grow, to keep enough cash in the business. I've had clients that have had equipment and vehicles that they own free and clear, but they've needed some working capital. And so we've been able to leverage those machines to pull cash out of the business. And that's a lot cheaper than selling equity or trying to find an investor. I've had a couple of fractional CFOs that have recommended consolidation loans for some of our customers where they have several loans that they're paying a variety of rates on that we can bundle all into one. And oftentimes, if we're able to consolidate those loans, it puts them into a better position where their monthly outlay is actually less than what it was before. And now they just have one loan to service rather than multiple. And refinances as well. If they've so we can consolidate, we can refinance, and we can also leverage existing equipment. And I think all of those ways are creative and smart ways to generate cash for the business for growth or for working capital, and just to position them in a situation where they are more safe, more comfortable going forward, having that cash reserve.
So, how can business owners who are operating inside these industries really understand if the assets that they have are leverageable? Is there any type of a test? Like the first three things that come to mind or that you advise somebody to ask themselves to know if that's actually an option?
Yeah, and one of the things we use an AI tool to do equipment valuations, and so I think in today's world, if a business owner has any question about the value of an asset that they have in their business, it's really easy to just put the specs of that asset into AI and say, here's the year, make, model, hours, and a description of this piece of equipment. What is an auction value? What is a retail value? And then if you take a blended value of those two, that's what we consider to be today's value, and what it might be worth. And so when we look at a refinance deal like that, we'll get that blended value, and then we'll lend up to 80% of that blended value amount to the business. So we've got a little bit of equity in it, but they're also able to pull some cash out of something they own free and clear.
Thank you. So I think the next thing I'd love to get your impression on is skepticism around alternative lending. So are you running into that, finding any type of skepticism with business owners who maybe have had a negative experience? And my second part of that question would be, how can we as a business owner really distinguish between strategic capital that's going to help us grow and maybe financing that's going to create more problems for us?
Yeah. So, one of the unfortunate things about my industry is that there are a lot of lenders that are unregulated. And that can be a good thing because they can do deals that the banks won't do, but it also lends itself to a lot of predatory lending. And I've seen a lot of out-of-state lenders that call into other states, and they tell a customer they're pre-approved, and they tell them you're pre-approved, here are the loan documents. And the customer sends them back with a first and a last payment, and then they work it backwards. They tell them they're pre-approved, they get them to sign loan documents, and then they go and try to place that deal with another lender, or they try to underwrite it themselves. And if they can approve it pursuant to the terms they quoted, great. But if they can't, they either go back and try to change the terms with the customer, or they just keep the first and last and tell them, you've paid that. We couldn't get it done, but for the time that we've spent in looking at this, we're just going to keep your money. And the business owner doesn't really have any recourse, because if it's a few $1,000s, to hire an attorney to chase that money from a company that's out of state isn't feasible. And so I've run into a lot of businesses that have had a lot of dirty tricks pulled on them by unregulated lenders. And there's a lot of competition in our field. And when the economy gets really good, there's even more competition. And so there's a lot of things that pop up. And so I've always said throughout my career that one of the best customers that I can be referred to is somebody who said they'll never do a loan or a lease again because they've been burned in the past. And I love those opportunities because my company doesn't play any of those games. Everything is transparent, everything is straightforward, and we have an amortization schedule that we give them. The rate is disclosed on the documents. It's very plain English and very simple and crystal clear to understand. There aren't any hidden fees. Some lenders will do quarterly commencements where they'll get you to sign the paperwork today, but they actually won't commence your lease for 3 months. And so a 60-month lease now turns into a 63-month lease. You didn't know that you had 3 extra payments because they commenced your transaction later. There's just a lot of things that can happen. And a business owner, from their perspective, they want it to be easy. They don't want to spend a lot of time on it, and then they need the equipment now. They want it to be fast and easy. And that plays right into the hands of a predacious lender that can pull the wool over the eyes of an unsuspecting business owner who doesn't really know what to look out for. And once they've signed that paperwork, they're locked into whatever that lender has laid out for them in their documents. And so I love dealing with companies that have had a problem in the past, just to show them how we're different and show them how easy and straightforward it can be.
There are several parts of what you just described that feel exactly like several car buying experiences I've had, where I love it when they give you the price of the car, but then when you sit down at the table, they want you to agree to the terms, but they're not really going to tell you, like, well, what is this translating to? So they say, can I get you a payment at this number? And then that's what they're working on. So it's not about what's actually affordable. It's about, can I get you to agree to these terms? And then if I can't get it done, I can sub it out for something else later. And actually had somebody that I just know that went through that and ended up taking the car back because they just couldn't get the deal done for what they said they could do it for. So, and ultimately they got their money back as well. But there's a lot about that that's very predatory.
Yeah, and it can be extremely frustrating, and it can cost them a lot of money if they are unsure what they're signing, because they need to have it right away. They want it to be easy, and the easier it is, the faster it goes. But once they sign it, now they're in a 5-year contract that they didn't understand, and they're going to pay money that they didn't expect to pay, which is unfortunate.
So how can we determine, just very quickly, whether we would want to pursue traditional financing, equipment financing, asset-based lending, or an alternate type of capital solution?
How can you determine which one is the best fit?
Yes.
Yeah, so that's a great question too, and it depends on the sophistication level, I think, of the business owner. If they kind of understand the differences between those products, then they can kind of shop around and see which one they think is the best fit for their business. I would always advise them to use a fractional CFO or to use a business attorney and somebody that they can consult with if they're not familiar with all of those different lending opportunities that are out there, because there are a lot of differences. There's a lot of difference between a simple interest loan and an equipment lease, as far as your flexibility and who owns it and how it gets depreciated and who takes tax advantages and all those things that a business owner may not understand. They're looking at, I can get this piece of equipment for this monthly payment, and I need to do it, and I need to do it now. I don't care if it's a lease or a loan. But I think that, again, if they rely on a CFO or a fractional CFO or a business attorney, someone that can help them navigate those to see which one is the best fit for the business, well, because they're making a long-term financial decision and they're going to have a relationship with that lender for 2, 3, 4, 5, 6, 7 years, it's important to know upfront exactly what you're getting yourself into.
So I have to ask this, Eric, if there's one thing that you wish every business owner understood before we started looking for capital, what would that be?
If there was one thing that I wish that they understood, I wish that they understood how important it is to be organized and understand what they're doing. So just like you said, which one of these products is the best fit for my business? A lot of business owners don't want to wear the hat of talking finances. They're very good at what they do. They're very passionate about their product or service. That's where they excel. But when it comes to the books or the numbers or the business side of their business, a lot of them don't want to spend that time doing that. But what they don't realize is that a little bit of information, a little bit of education can really go a long way. So when they put a loan package into a lender, the more complete, concise, and accurate that information is, the more clean it is for the lender, the better opportunity it has of getting approved, the better opportunity it has of getting a better rate. When I get a business owner and I ask them for financial statements and they send me tax returns, and then they send me financial statements that don't balance or that don't add up or that create more questions than solutions they provide. And I have to go back. My credit manager will look at it and say, does this business owner even know how to run a business? He doesn't, he or she doesn't know how to even present a financial statement. So what is that? It reflects on their ability to borrow and our ability to enter into a long-term relationship with them. So the cleaner it is, if it's packaged properly and they have somebody who can consult with them to help them submit their transaction in the best possible light, they're going to get better rates. They're going to get better lenders. It's going to be an easier process for them.
I think, good reporting is central to any business. And I think it's one of the things I see businesses struggle with the most. And there's so many different tools and options out there for bookkeeping and for producing reports and for gathering data out of your business and presenting it. I think it can be confusing. Are you seeing any businesses who are integrating, and this is kind of a two-part question, integrating AI into helping produce cleaner information for you? And then the second part of that question is, are you guys using AI with what you're doing inside your own workflows and or as part of your underwriting workflow?
Yeah, so great question. So I haven't seen too many businesses, at least in my experience so far, using AI to present a loan package. But that, I'm sure that those tools are out there, and if they are, I would highly recommend that they look into what's available to them and see if that can help them organize things, clean up books, and present a package that is complete and easy to understand. As far as our business, yes, we do use an AI tool that we recently purchased, and it has been a game changer for our business. And what it does is when the customer submits an application, financial statements, bank statements, tax returns, when they submit a credit package to us, we just forward it on to the AI. The AI takes about 10 minutes and it analyzes everything. It'll pull the Secretary of State report. It will pull the DNB. It will pull the PayNet. It analyzes all the financials, all of the bank statements. It gives us all the ratios, charts. I mean, it gives us an overview. It checks the business location, their online presence, their reviews. I mean, it gives us a 30,000-foot view of the business in 10 minutes. And it has been a game changer, because before that, manually, we were having to go out and chase all that stuff down individually from different sites and gather that ourselves. And now this tool just does that for us. And it's been amazing. It's been an amazing time saver. And now I get that analysis, and I'm able to sit down with my credit manager, present the transaction to him, and virtually all the questions that we normally ask are answered in that analysis.
You just touched on a few things that I think speak to the structure of the business that oftentimes I see business owners really discount, and that could be the location. So say they've got a virtual office set up somewhere, and that office has maybe at some point been associated with fraud, or their online presence doesn't check all the way out, or maybe even, and this is one you didn't mention, but I've seen this happen, they've got the wrong NAICS code assigned to their business. So it's a high risk code. So when you say your AI is going out and looking at those things, or it's evaluating their online presence, what all is it really looking at that it would flag for you? Just that there is one? Or are they looking for is it looking for certain things on the website, for instance?
Yeah, so it combs the website, and it gives us a know your customer profile. And so it checks their social media. It checks any reviews that they might have had. I mean, this AI tool will tell me if they've had negative reviews, or if there's been any negative news about the business or the business owner, if they've been reported for doing anything fraudulent or anything, and it's appeared in any kind of public news outlets, that will appear in there. So yeah, it just kind of crawls out there and finds whatever it can, and then just aggregates it all into one. But it does check a lot of the business entity things, and the like DNB, PayNet, and those things that we kind of rely on as a lender to assess creditworthiness.
I think there's so many different factors that I think go into funding readiness these days. And I think there's just a lot of misconception about how important some of these are. So when a business owner comes into you, where do you send them, or do you take the time to educate them yourself when they come in and you see that your AI has flagged something? What does that path look like or roadmap per se for the business owner if you see that there's work to be done there?
Yeah, and that's one of the things I really enjoy about my job is working with a business owner and telling them, hey, this is what we are seeing. Is this accurate or is it not? And having a conversation with them because there are times when things have been reported that aren't accurate, and they've been able to provide evidence or proof of that to be able to help us get over those questions to be able to get their loan done. And I find a lot of satisfaction in going to them and saying, hey, this is what I found. Is this accurate? Is this up to date? Or, and if it's not, they provide me with the information to show what is the truth, and then we can just move on from there and to still help them to be able to get a loan rather than just saying, no, sorry, you're declined, we can't help you, and then just moving on. So we don't like to say no. We try to find ways to say yes as much as we can, and sometimes having those conversations, educating people and letting them know what we're seeing and where they stand and what's being reported, what's out there, and trying to correct it and trying to get accurate info.
Are you guys also looking at what's existing in LexisNexis? Because I'm finding in some cases, not everybody's aware of, what LexisNexis is or why they should be considering it, personal side and business side for verification on what's reporting. So is that a tool you guys are looking at that your AI is taking into consideration?
That's a good question. I'm not sure if that's one of the metrics that our AI uses or not. Specifically, it's not listed in the report that we get, any kind of notes or information from LexisNexis, but it could pull from that. I'm not sure exactly what all the intricacies are of the AI.
Fantastic. Thank you, Eric, so much for joining us today. This has been a very enlightening conversation. You've given us so much to think about and some really great action steps. Can you tell our audience how they can find you on LinkedIn, connect to you on social media, and on the internet?
Yeah, absolutely. The name of the company is Solutions Financial Services. Our website is sfslenders.com. And we do loans from $100,000 to $5 million, and we kind of are positioned right next to the bank. So if the bank won't do the deal, that's usually our best option. Is our best customer is somebody who's just recently been turned down for a kind of a trivial reason. You can find me on LinkedIn. My name is Eric Olsen, Olsen. With Solutions Financial Services. And again, I'll just leave you with the thought of if you know someone or if you know of a business that the bank has told no, then just call Eric O, and we'll see what we can do for you.
I love that. It's so easy to remember. Thank you, Eric, so much for joining us. And until next time, everybody.